there's a few things I want to accomplish. Obviously, I want to be mindful of everyone's time and conclude this meeting in a timely fashion. But the first thing I want to do is to introduce myself, say who I am, talk about why I'm here this evening,
Mhm.
one speaking, and also in terms of BEM Capital. I'd like to share a little bit of my thoughts of what we can do with the legal cohort going forward, always open to ideas. And then I would like to segue into talking about private equity, venture capital from a legal lens. And when I do that, I'm going to give you a caveat. Some of the things I'm going to talk about are going to be fundamental, foundational, also providing an overview because I know people are coming to private equity, also venture capital with different base of knowledge. And so I want to provide a foundation this evening and also be a resource. And I know that there might be questions this evening. Some things I would be able to answer, some things I might not. The reason I say that is because it really depends a lot of times on the facts, the situation that a person is in, the rules, the laws, the regulations can vary from jurisdiction to jurisdiction. So if there's a question that I think might need to be tabled and taken offline, not that I'm trying to avoid your question, but because this is a public setting, obviously there's no attorney-client privilege. So I'm going to be talking at times at a high level, providing an overview, and of course encourage anyone that has any potential issues or actual issues to speak with an attorney offline and try to work through those issues. So first, who am I? Dominique Carroll, most people call me Dom, so feel free to use that. I'm a partner at the law firm Fox Rothschild. A little bit of background about the firm. Currently we have about 30 offices coast to coast, about 1,000 attorneys. We handle a lot of different practice areas. My practice focuses on a few main categories. First, I do a lot of work in the intellectual property space. So that's helping clients with their copyrights, their patents, their trademarks, and their trade secrets. And that's on the transactional side and also on the litigation side. And what I mean by transactional, a lot of time that might involve licensing deals, negotiating the right to use or to sell a client's intellectual property, a lot of negotiations. On the litigation side, a lot of experience representing clients who are asserting that someone is infringing on their intellectual property rights, also defending clients who have been accused of infringing on someone else's intellectual property rights. So that's one main bucket of what I do. I'm also a member of our firm's emerging companies and venture capital practice, which I'll talk about a little bit later. And another thing that I do is a lot of times I'm able to work with clients and serve along with my colleagues at the firm as their outside general counsel, because sometimes clients, either because of their size, it doesn't make sense for them to have in-house attorneys, or sometimes it makes more sense for them to send some task to outside attorneys like my firm. So that's another main area. So, just again, a recap: intellectual property, working with emerging companies and venture capital, and also business advice providing to different entities as their outside general counsel. So that's a little bit about who I am, why I'm here. I'm here for a few reasons. One, I'm just still really motivated and excited after attending the recent BEM Capital private equity event down in Miami. Met a lot of great gentlemen that evening. I learned a lot from them. I'll continue to learn from them. And so one reason I'm here is to continue building those relationships, continue to grow and learn from each other. Also here as a member of the legal cohort. as a representative. And in terms of some of my ideas for going forward, obviously tonight, you'll probably hear a lot from me, but in future months, at least one of my ideas is to spotlight other members of the community. So there are a lot of really talented attorneys in the group. And so during future months, I would love to have a conversation with some of those other attorneys, because the other attorneys have different focus. Some might be focused more on the M&A side. Some might also be focused on the real estate side. And so you have different perspectives. And I think that that would be a good dynamic to have the back and forth between myself, other attorneys in the group, and also members of the broader BEM Capital community. And also I would like to spotlight the other members that are not attorneys, because we have limited partners in the group, we have general partners in the group, we have people that have years of experience in private equity, venture capital, and we have people that are new to the space and are trying to learn or in the process of forming their first firm or launching their first private equity fund. And so I think it would be a good idea to use this platform to bring them on, also spotlight what they're doing. And I'd like to borrow from one of the BEM Capital members, Rob YB Youngblood, who talks about collaboration creates currency. And for that collaboration to create currency, we need to know each other's skill set, what we're doing, what type of deals we're working on, what we're looking for, who we want to be connected to. And so I think that this could be a great platform for getting to know each other, deepening those relationships. And so as also Jewel talks about, friendship and relationships first, and the business will follow. So I think this could be another mechanism for us to achieve those goals. Now, talking about some of the stuff that I do and bringing that legal perspective, one thing that comes up a lot of times, people think of attorneys sometimes as a cost center. Attorney's the person that where they're sending invoices, money's going out the door, but they don't always see some of the value of getting an attorney involved throughout a company's life cycle. And so tonight I would like to talk about some of the different ways that working with an attorney can be beneficial, instead of just being reactive when something goes wrong or you think something's about to go wrong. Being able to work with an attorney to be proactive a lot of times can save money and can save you from a lot of legal headaches. And so that's one of the things I want to talk about, and also talk about the different perspectives that people have and the different needs that they can have for an attorney throughout the company's life cycle. Especially we're talking about private equity and we're talking about venture capital. And because people are coming to this from with different backgrounds and different knowledge of the field, I hope that you'll give me some grace, and because I want to cover some foundational information that might seem simplistic for some people that are watching, but I'm hopeful that others will gain some insight and learn some new things. And so one thing that is very common throughout the finance world, and especially when we're talking about private equity and venture capital, there are a lot of acronyms that are thrown out and people are using them, and sometimes people don't always know what they mean. You're having a conversation with somebody and they're throwing out LPs, they're talking about carried interest, they're talking about GPs. And so I like to at least try to get a baseline, provide some foundational information that we can use for a conversation and for also building in future speaker series that we're going to have through this platform. And just at a basic level, from a legal perspective, when I hear somebody talk about a private equity fund, what am I thinking about? I'm thinking about a legal entity, which is just an investment vehicle that was created for the purpose of making equity investment in privately held companies. And normally, a private equity fund is going to be deploying capital in companies that have really strong growth potential and the potential for value creation. In terms of structure, get into some of those acronyms I was talking about. Limited partners, or the LPs, those are the investors in the fund. Those are the investors that are providing capital to the fund, and no surprise, they expect a return on their investment. Sometimes that's institutional investors like pension funds. But one thing that's important to keep in mind is that the limited partners, the LPs, they're not involved in the day-to-day operations of the fund, of the firm. They have a very passive role in the fund's management. Conversely, you have the GPs, the general partners, and in terms of a PE firm, they're going to be responsible for the fund's investment decisions, deploying that capital from the limited partners, and also the fund's management. The general partners, those are the individuals that are actively managing the portfolio company and handling the overall operations of the fund. When we're talking about funds, the funds have a finite lifespan. They don't go on forever. Oftentimes, obviously, there's variations in this one time. I'm talking in generalizations. Generally, you're talking about 7 to 15 years lifespan for, and talking about PE funds. And during that time, you have the general partners who are investing that capital that was committed from the limited partners into the portfolio company. Those general partners are actively managing those investments, and hopefully they're going to exit that investment for with a good return, a good multiple on their investment. The investment period, that's the time frame that the general partners are actively investing that capital that was provided by the limited partners. Again, that varies how long it's going to be, but a lot of times I see usually the first 3 to 5 years of the fund's life, that's when the GPs are actively investing that capital. Now, in terms of the types of funds, there's a lot of different types of funds which fall under the broader umbrella of private equity. And so I'm not going to get into all of them, but at least just so we can have a common understanding, I think it would be useful to talk about some of the main types of funds. And one, which is very common, a lot of people talk about, venture capital funds. And so in terms of a VC fund and firms, we're talking about entities that are investing in early stage, high growth companies. Sometimes those companies are not yet profitable, but they have strong growth potential and potential to create a lot of value for the investors, even if they don't have significant returns yet. And so you think about what is the investment stage for those type of funds. Early stage might be at the seed, Series A round. This is a high risk, high reward area to invest because a lot of times you're dealing with unproven startups. Another type of fund, we have growth capital funds. So those funds are targeting companies that they're past the startup phase I talked about with the VC funds. Now you're talking about companies that are trying to expand their operations. Perhaps they want to enter new geographic markets. And so they need capital, or they need capital for product development, or perhaps they need some more capital to expand and capture more market share. And so that's another type of fund. And this time you have a fund that their investment focus, they're looking at companies past the startup phase, likely have a proven business model, still have high growth potential. Another primary type of fund, buyout funds. And so in terms of buyout funds, what I'm thinking about are funds that have a focus on established firms that need operational improvements. Sometimes they might need a strategic realignment. These are typically more mature companies that really need a strategic transformation. And the last of the primary types of funds that I'll mention at this time, turnaround funds. And so now I'm referring to funds that are targeting distressed assets or companies that need an operational turnaround. A lot of times these are troubled companies that need a revival, high risk, of course, due to the nature of working with a troubled business and trying to revitalize it, but there can be a lucrative exit if you make the right investment. And so that's a mouthful of very broad overview of some of the primary types of funds. And from there, I think it could be a good use of our time to try and talk about where does the lawyer or lawyers, where do they get involved in the company's life cycle? And now that actually happens a lot of different times, throughout the company. From entity formation, you can have an attorney involved. It might be advantageous, all the way through the exit, whether that's selling the company, selling the majority of the assets, an IPO. An attorney can be a useful strategic partner throughout that time frame. So a lot of times, let's talk about what's the perspective of an entrepreneur and why they might need to think about talking to an attorney and how that can be helpful. So let's say somebody wants to form an entity. They want to launch their first private equity firm. Okay, so one early call to an attorney could be to talk through entity formation. There's a lot of different entities that someone can choose to use, but an attorney, and one of the things that I do, walking the client through trying to understand what their goals are, what are their short-term and long-term ideas for the company, their target market, their fundraising strategy, all of that information. Where does the company intend to operate? All of those types of questions can be useful in providing advice about entity formation. For example, should it be an LLC? Should it be a corporation, a C Corp? Should it be an S Corp? Also, jurisdiction. Where should the company incorporate? Should it be in Delaware? A lot of companies, especially startups in the private equity, VC world, also a lot of large publicly traded companies are headquartered in Delaware. And there are some potential benefits for incorporating in Delaware, but there are also other considerations that it would be important to talk to an attorney to get an idea of whether that's the right location. Instead of just saying, well, I know a lot of startups or some large Fortune 500 companies are headquartered in Delaware, I should headquarter my company and incorporate in Delaware as well. That might be the right decision, but it might not. And so that's another situation where it can be useful for an entrepreneur, for a founder, to talk to an attorney to make sure that they're picking the right entity for their company's creation, and also that they're choosing the right jurisdiction, the right location to form that company. Another reason that it can be useful, even for an early stage company, to speak with an attorney, are considering things such as, if let's say you're forming a corporation and there's shares that are going to be issued, should there be a vesting schedule for that equity? That's something that can talk through with an attorney. An attorney can help to advise whether, for example, the founders, their equity should invest over 4 years, over 5 years, how that should occur, getting those documents in place. Also, another benefit of working with an attorney even early on is creating some of those key foundational documents. So if you're forming a corporation, referring to the stockholders agreement. If you're forming an LLC, the operating agreement, which are very key foundational documents, which can be helpful for governing the overall management of the entity. Also, restrictive covenants, which is something sometimes early stage companies don't think about. But founders, also investors in a startup, they're going to want to make sure that usually that there are restrictive covenants, that they have the right documents in place, for example, so that, let's say there are multiple founders, one of the founders leaves and they form a competitor. Is there anything to prevent them from soliciting customers or employees away from the startup? That's where documents such as, clauses such as a restrictive covenant, certain documents can be very useful for protecting the startup. Also, I talked a little bit earlier about intellectual property. So another key thing that comes up even at early stage companies, inventions, and also the assignment of those inventions. And so if you think about a company, this can be a portfolio company for a portfolio company of a private equity or venture capital firm. How many people are going to have access to that company's intellectual property? It could be the founders, the original founders. It could be employees, it could be suppliers, developers, such as perhaps software developers might have access to the intellectual property. Independent contractors could also have access to that company's intellectual property. And that's something you want to be able to, as a person that's running a company, you want to be able to protect and also monetize the company's assets, especially their intellectual property. And part of that requires having a solid intellectual property protection strategy. And so sometimes that's ensuring that everyone that has access to the intellectual property is signing the right written agreements. That's essentially ensuring and providing that any intellectual property that's created in connection with services performed for the company are assigned to the company. Without that type of agreement, someone, it could be an individual, it can also be an entity that has access to intellectual property that are providing services. They can try to assert potentially ownership rights in the company's intellectual property. And that's one of the times when I talk about being proactive, working with an attorney can be a lot less costly than having to go into litigation to try and prove that someone misappropriated, let's say, for example, patented technology, software code, trade secrets. Potentially down the line, might be able to prevail in the court of law. That's a very time-consuming and resource-intensive situation that you will want to avoid if possible. And so getting an attorney involved to find out what inventions a company currently has or they are on the verge of creating, and working with an attorney to develop that intellectual property strategy, which includes protecting those assets, can be a worthwhile endeavor. Also, incentivizing employees and other individuals that work with the company. So getting an attorney involved can be useful for example, creating an equity incentive plan. If there are going to be stock options that might be issued, if there's, for example, an employee stock ownership program, or if stock options are going to be issued to either entice new people to join the company or for retention, that's another situation where it can be useful to work with an attorney to get some sound legal advice for the best way to structure that. So that's more on the side, talking about founders and entrepreneurs. It's good for them to have an attorney, especially if they're seeking to raise capital from private equity or venture capital, because the firms that are deploying the money, they have attorneys. And so you want to make sure that everyone's interests are well protected. And I'm not saying that sometimes the people with the capital are trying to do anything nefarious, but sometimes there can be good faith misunderstandings of even what should be simple terms and conditions. And so it's good to have an attorney that's involved that can help negotiate those terms and conditions and make sure that everyone's on the same page. And just giving a brief example, what happens if you have a company, you're trying to raise some outside capital, you have some good conversations with an investor, and the investor says, I love the company, this is great, I'm going to have my attorney draw up the the initial term sheet and so what I think about your company is that I'm going to invest, let's say, $10 million at a $30 million valuation, right? That in theory sounds pretty simple, but that can be interpreted multiple ways, right? So are you saying that is the investor in their mind, or are they saying that the company pre-money is valued at $20 million and they're going to invest 10 million into the company? Or are they saying that the company they think is currently worth 10 million, they're going to put 10 million and post money is going to be worth $20 million? Something that simple, two different people can have very different understandings of some of the terms and conditions. And so it's good to have an attorney involved. So to have what we call the meeting of the minds, making sure that everybody's on the same page, has the same understanding of the structure of a potential deal, the key terms and conditions that are going to be enforced going forward as you're trying to go from launching the company to potentially getting financing, right? Obviously, it's important. You want to have that term sheet. You want to get that letter of intent. You eventually want to get to the closing, but there are a lot of steps along that path where it can be useful to have an attorney that can be able to help the different parties, whether it's founder, whether it's the executives of the company that's seeking the capital, whether it's the GP of the private equity or the VC fund. They all have an interest in having attorneys be involved to make sure that their rights, their interests are well protected. And so that's another reason why it can be useful to have an attorney involved to review the documents that are going by and also help throughout the process, because a lot of times we have very sophisticated clients, whether it's founders, whether it's senior executives of a company, or it's people that are involved with on the GP side, a lot of bright individuals, but it's useful to have an attorney to walk everyone through the process and to be a strategic partner. Like, for example, if you're going to try and raise capital and you get to the stage where the potential investors are asking for due diligence materials, that's something that can be very useful to have an attorney help walk through that process, which can be very invasive in terms of providing a lot of your legal documents, your financial documents, potentially information about major customers that might need to be turned over as part of that due diligence process. So having an attorney that can advocate on your behalf is very useful throughout the process of everything from forming the company to raising capital to deploying capital to buying assets, selling assets. These are all situations in the company's life cycle where it's important to think about, is this a good point for us to bring in an attorney to review where we're at, see our goals in the short term and long term, and see how they can potentially help us reach those goals? Because a lot of times you have either the company that's seeking the funding, they're not thinking about all the other issues that might come up. Obviously, on the one end, a potential portfolio company is thinking about growing their operations, their top line, increasing that, decreasing expenses, trying to either go to market or expand their market share, and also to bring in capital. But are they thinking about potential, for example, immigration issues that might be involved in their company? Are they thinking about potential labor and employment issues that might arise in their company? Those are another situation where it can be useful to get an attorney involved, whether that's to draft an employee handbook, to provide training, for example, about discrimination, about whistleblower protections, different matters that can come up, even the different types of employment agreements that might be issued. So sometimes the companies are not thinking about all the employment issues that can arise, but that's something that an attorney can think of as the company is trying to scale up or even trying to raise capital, thinking about some of those other issues that can be, useful to consider. So I talked about earlier, a lot of times it's good to get an attorney involved to discuss and work through benefits and executive compensation. Just talked about employment, which is another big issue. Also, real estate. A lot of companies now are virtual or primarily virtual, but what about if a company is expanding and they need to sign a lease for a physical space? Perhaps there's some pushback from the local municipality and you need an attorney with a real estate background to try and help through any land use or zoning issues that might pop up. What if a company is based upon their type of work, there are environmental issues that might come up. And so I think sometimes companies, understandably, if they're trying to go out, raise private equity or venture capital funds, they're thinking a lot about getting to close the deal, understandably, and it might not be top of mind all the other legal issues that can be percolating in the background that can be very costly in terms of time and money down the line if things are not handled appropriately. Also, taxation issues. So sometimes it's very useful to work with an attorney that has a firm understanding of taxation so that you can try and structure the most tax efficient deals. And there are a lot of tax related issues that can come up throughout a company's life cycle, especially when a company is trying to raise capital, if a company is considering issuing stock options, considering should they issue warrants, how they should compensate executives. There are a lot of potential tax implications to those type of transactions, and it can be very useful to have somebody with a legal background to try and make sure that the strategies that are being implemented are the most tax efficient. Also, another major issue that comes up with companies that are seeking capital, data privacy. That's a huge area now. There are so many regulations that companies and individuals have to deal with, depending on the nature of the business. They might have access to protected health information, and there's issues around that, how it needs to be stored, what to do in a situation if there's a potential breach of that protected information. And so, again, it's useful to think of having an attorney or attorneys as part of the team that can help the company and alleviate some of those legal headaches, help with some regulatory issues that might arise. I was trying to, you asking a question or?
Oh, I got an automatic light here. I'm trying to
Oh,
turn it
okay.
on.
I thought you were waving me down.
Hey, I mean, Dominic, I'll throw some questions at you. I know you're flowing.
Mhm.
I mean, so I had a lot of the questions I had coming into this call around legal, really has to come around like disputes, right? And you've been hitting on a lot of key disputes. I'm sure that you might see, right? Whether that's within the operating agreements, could be enforcing clawbacks, could be employment agreements, could be conflicts of interest. obviously the trade restrictions, obviously with your background around patents as well. First-time fund managers and emerging fund managers, in terms of like top three, because you're spinning out a bunch. What would be like the top three type of disputes that you would categorize that they just don't see coming? Fund managers just don't see coming, whether it's because they're either scaling their operations so it's here they've never been, or they're entering a space for that first time. I'm just curious.
Say the top three taxation issues, which I touched on briefly, depending on the nature of the business and also where they're operating, whether it's domestic, whether it's international. I think sometimes, well, a lot of times companies I've seen have not really thought through all the tax implications of operating in different jurisdictions, even throughout the US, but also internationally. And piggybacking on that, another issue is, I talked about intellectual property protection. And a lot of times fund managers might be very used to the intellectual property system in the US, which is very developed. We have a lot of case law, a lot of great judges that are well versed in patents, copyrights, trademarks, trade secrets. And so there's a great body of case law and knowledge throughout the United States. But what happens if a company has intellectual property in the US, but they're trying to perfect and protect that in a different country, right? What if they're expanding to the BRIC countries? What if they're talking about they're trying to go to places in South America, Latin America, places in Europe, going to Japan, going to China? There's different intellectual property regimes in different countries. Sometimes you might be able to get a benefit from certain international treaties, but that's a time where it's very useful to reach out to an attorney, because your intellectual property strategy in the US and the protections that you have in the US sometimes don't translate as strongly in another country that you're trying to do business in, or that you might want to expand to do business. And so sometimes that goes into the calculation of, should I expand into that other country where I'm not going to have as strong intellectual property protections, or does that still make sense? Is it still feasible for me to transition into that other foreign jurisdiction? So I think that that's another area a lot of times that I think there's oversight, lack of oversight, and they just miss out on understanding some of the nuance there. When you're going from the US to another country, you're thinking, okay, well, I have the strong protection in the US, doesn't it carry over if I go to another country? And so that's something where, I've been involved working with counsel in different countries that have offices, have boots on the ground, decades of experience in those different countries. And we're able to bring that knowledge to our clients to let them know, okay, well, this is what we have in the US. If you're trying to expand into these other countries, this is what you need to consider in terms of protecting your intellectual property, what the trade-offs are, and armed with that information, fund managers can make, hopefully, an intelligent business decision. But it's really about having that knowledge. So I think that those are the top two that come to mind. I think the third issue that comes to mind is just, I think, the difficulty of managing a lot of portfolio companies, or even several portfolio companies, because you're dealing with people, different personalities. Even if your fund has a particular focus, let's say you're focused on technology, biotech, you're focused on real estate, you might be focused on a specific industry, but you're dealing with a lot of individual personalities, different potential entrepreneurs, different potential founders. You have situations where founders, everything is great. You're talking about the operating agreement, the stockholders agree. What happens when you have 3 or 4 founders and one of them decides to leave a year after they founded one of the portfolio companies? You were talking about that earlier. What happens to their equity, their voting rights. Is it going to be a drag along? Is it going to be a right of first refusal? And so a lot of times what you're talking about and why it's important for the fund manager to obviously have counsel is because they're coming at it from a different perspective. They're going to be usually focused on ensuring that there's certain terms in there in the term sheet and the final binding document that give them strong control rights. And also it might be a big fight about, let's say they're investing into some portfolio companies, and in exchange for their investment, they're going to get preferred stock, right? So it might be, how are we going to talk to with the founders about giving the fund manager a 1x liquidation preference, a 2x liquidation preference? Should they also not just be a 1x or a 2x or higher multiple liquidation preference? Are they also going to be able to be participating when there's a liquidity event such as selling the company, right? So if there's a 1x or 2x liquidation preference, so the investor is going to get back either 1, 2 times, maybe more their initial investment, but are they also going to be able to, if there has been significant appreciation in the portfolio company, able to also benefit and participating as if they converted their preferred stock into common stock, and they're getting those returns before the common stockholders are being compensated. So I think there's a lot of tension in terms of that, and also related. So, I talk about the economic terms that go into structuring the deals. There's also the control terms. What about, how are we going to negotiate with the companies and get everybody on the same page in terms of things? If we have a corporation, there's a C Corp that we're going to invest in as the fund manager. What about the number of directors? How are we going to get agreement on the number of directors? How are they going to be appointed? What happens if a director resigns? What happens, to your point, if there's a conflict of interest? What happens if there's an allegation of a breach of fiduciary duties, right? You might have D&O insurance, but you also want to make sure that you have solid documents in place to really outline how the company is going to operate, and also what's going to happen when there's certain different events that might happen, such as having to bring in new directors, having to vote out a director, perhaps having to issue new equity, perhaps selling the company or selling a substantial part of the assets, going to an IPO. There are a lot of different things that can come up where there can be very divergent viewpoints from the fund manager and from the recipients of the investments. And so I think it's very important to be proactive and talk with an attorney to try and understand the overall strategy and what's the best way to try and mitigate some of that risk and some of those legal headaches. Now, everything can't be eliminated, but I think sometimes more work on the front end before issues are created is better than on the back end trying to be reactive and either having to file a lawsuit or defend against a lawsuit, which is I know very well. It's a slow process generally, and it's a very expensive process for everybody involved.
Oh, super helpful. I mean, it sounds like some of those things, as a first-time fund manager, should be thinking about those things before going into an investment. I guess in a quick follow-up, I think, bring it all the way down, but is there like a ratio you would put it on in terms of first-time fund managers being prepared to face some of those issues, whether it's in their firm level, at the portco level, LP level? How prepared do you find folks to be?
And you're focusing on first time?
Yeah, let's look there. First time, yeah.
From my experience, not very prepared, unless they're, to your point earlier, they're engaging counsel early and often. So that's usually the best strategy, because a lot of things you can talk through. You can game plan, you can strategize different things that might come up down the line, and what's the game plan if it does happen. Hopefully some of those things will not pan out, but it's good to have an idea in place, a game plan, and just like game of football, don't only just want to be offensive, you also got to think defensive, and what are you going to do if certain moves are made on the other side? How are you going to respond?
Great point. Great point. I think Kamar popped off. Kamar, do you have a question for Dominique?
Yeah, I talked with Dominique earlier. That's why we were laughing. We were talking about some of the challenges and why you need to engage these guys. But I guess the question I would have, and again, it may be for startups. Can you kind of tell us maybe, or in your experience, if you don't do these things right, and you start raising money and you get us, and most of the time you're dealing with qualified investors or accredited investors, and they start to do due diligence on you, and you don't have your ducks in a row, the risk of what that can do, of not being prepared for those type of investors, or let's say even above an accredited, there may be an institution or an intermediary, and you don't have your ducks in a row, and how that caused you.
Well, from my experience, that can be very problematic. And just taking a step back, if you're getting to the point of serious due diligence, right? So this isn't just you met somebody at a cocktail party or you had a couple conversations and potentially they're going to invest and they're just throwing out potential numbers and valuations. Maybe they're a potential a strategic acquirer, or they're somebody that has knowledge of the industry. So, if you're going past those initial conversations, you're getting to the point of, let's say there's a letter of intent that's exchanged, and now they want to do some significant due diligence. From my experience, it's problematic if you don't have that information at least readily available. Doesn't mean that you're going to need to respond to it on the same day that you get the request, but a lot of times they're asking for financial records that you should be able to produce or get your hands on. They're asking for sometimes major customer lists. Now, on the other side, you could work with an attorney and say like, well, especially if this is a potential competitor or somebody in the same space, maybe you don't want to give a list of your top customers by their actual name. You can use some type of codes to refer to those companies, and different things that you can talk through with your attorney. But a lot of this information is information that you should be able to get. And if you can't, especially working with your attorney who can sometimes help say, what things we should push back on in terms of producing, what really does need to be produced, what really matters. But these are all documents that a company that's serious about raising capital should be able to get their hands on within a reasonable time frame. So again, I'm not saying you get the due diligence request today, there's a list of items, you need to have everything within 48 hours. That's not reasonable. But if multiple weeks are going by, you're not able to produce the documents, or there's issues with your financial records, that can be a problem. And you got to think about people that have significant resources and are able to deploy capital. Usually they have a significant amount of deal flow. And so you might have a great idea, a great business, but if they're looking and they're seeing this as a potential red flag where you don't have your financial documents, you don't have your legal documents readily available. For example, if they're asking for meeting minutes, board resolutions, showing that certain actions on behalf of the company were authorized, clear title to your intellectual property, those can be big red flags depending on the company that's involved. So I think the short answer is a lot of this information you should be able to have access to, especially if you're working with an attorney. Again, throughout the life cycle of a company, sometimes you can work with an attorney. The attorney might give you some form NDAs that you're going to need that you could use, documents, templates that you could use for your meeting minutes, for your resolutions. These are things that an attorney can help you create. And also sometimes attorneys can be depository for in terms of having copies of those records. Not saying that the business shouldn't maintain those records as well, but that can also be another benefit of working with an attorney. An attorney can, once we have access to the documents, can make a secure data room that they're able to upload the company's documents to, which make it very easy for the company that's doing due diligence to go into the data room, review the documents, everything's here. If they need to do a follow-up, they can send a follow-up email or letter requesting additional information. But I think, again, this is another time where it can be useful to have an attorney involved to help facilitate the due diligence process.
Yeah, thanks for sharing. That's a lot, because you're right, Dominique. Is attorneys are going to be more risk adverse because that's the way you're trained to think. And if you're an entrepreneur, you're not going to wait for all. I mean, you're almost the opposite. You're deal making, you're moving and shaking, and so these kind of details, you're just going to leave out. And it's painful to go through sometimes because you just want to roll, you just want to run, and you're ready to go. But I think it's not think, I know. In this space here is different than, maybe starting a barber shop or a couple of guys getting together buying some property. You're use that because I think probably everybody's done that at some point or had something invested into a barber shop. The the complex when you're raising money at the level that we're talking about doing. Now it's serious, and that scared the hell out of me. I've talked to Dominic already. I don't mind sharing, because I need help as much as I know. I don't know these details like he's talking about, and I'm going to miss him. And boy, it'll be painful. And fortunately, I've been talking with plenty of people, and I would advise everybody to speak with others. Just when you think you know everything, you don't. And talk with people who have done it at the highest levels if you can get those kind of connections and get their advice, and take the constructive criticism in a positive way, because it'll save you probably a lot. And I've helped launch the fund, and we had documents. That first fund, hell man, we must have revised documents 6 times. It was ridiculous. And we had some people, we just were moving too fast. That is a red flag to, like Dominic said, of a major, unless they like you, which most of these people do. But even then, it could cost you money. It cost you a 7-8 figure check possibly.
Definitely want to help you avoid that if possible. So definitely don't want that to happen. Sorry, would you say, David?
So I had a question, I guess similar to, now, is it Kamar or how you?
Yeah, that's me. Yeah, Kamar.
Kamar. So you talked about risk aversion and then lawyers, being or leaning toward a natural affinity to be risk averse.
Yes.
Well, the same can be true for finance folks. And so, because
I'm a finance guy. I'm a finance guy, but I'm also
but the reason why,
yeah.
Well, the reason why I mention that is because depending on the area of finance, most all of it is related to generating excess returns while reducing risk. So it's a dual sort of thing. So you have the entrepreneurship element where you're trying to generate large sums of money, excess returns, profitability, while minimizing risk. So there's that sort of dual risk aversion, like meaning if you're lending, like, and the reason why I said that, if you're working for a bank and you're doing underwriting, or if you're in insurance, the whole business model is you're taking risk, but you're taking calculated risk. So there's a level of risk aversion embedded into the activity. And so the reason why I brought that up is because, at least from my perspective, one of the hurdles that I had, and this is kind of leading into my question, is the entity formation and all those steps that you went through: growth phase, fundraising phase, dispute resolution. I'm fine with doing all of that. I'm fine with like kind of going, at least in the formation stage, doing things, with a small team of people or myself. But where I struggle though, and this is where the question comes in, if you are a newly formed entity or in the process of being formed, how would you, because I know it's not expensive, what would be your best, I know it is expensive, what would be your best recommendation to mitigate some of those risks that Kamar talked about while in the startup phase, meaning literal from scratch? You're not seed phase, you don't have any funding, but you need to engage with an attorney to help walk you through some of the elements that you talked about, the best entity type, the best location, the operating agreement, intellectual property rights, all those things. You don't have the resources to cover the cost of that risk mitigation via an attorney. So what would be some of your ways to do that? Would it be through partnerships? Would it be, what have you experienced startups doing? Do they source capital first to fund an attorney, or like how, what's been your experience with that?
So I think that there are, I mean, it's a really good question. There are a lot of things that are involved there. And I definitely understand the concern of perhaps not having the capital, especially early on, to do everything. And so, I don't want anyone to leave with the impression that, when you start a company, everything has to be taken care of right away, or that it's always going to be outside the budget of an early company. For example, that's why sometimes it's a good idea to talk with different attorneys, because sometimes different firms have different fee structures and different price points that can be economical for a company. And just using, for example, my own firm, we do a lot of work with emerging companies. And so we actually have what we call our launch pad, which is a startup package for companies that are looking to be created, and we want to make sure they have a solid foundation for the new venture before they even start fundraising. And so a lot of times we're able to come up with a fee structure, whether it's perhaps a flat fee that's able to give them some of the things that they need to get started. So part of our package, we will do the formation, filing the certificate of incorporation, the certificate of formation if it's an LLC. Perhaps you might have an attorney that's able to include an initial round of documents for a reasonable price, a minute book, which is going to include the bylaws, those initial board resolutions, restrictive covenants for founders, for employees, assignment of intellectual property, confidentiality, non-solicit, non-compete agreements. Those things can be economical. It really depends on who you're working with, and that can be a good opportunity to speak with different attorneys and find out what the potential cost is, get some quotes, and try to do it that way, instead of just thinking that, well, there's no way that we're going to be able to, for example, have an attorney cover the cost of the formation, or perhaps some of those initial documents, maybe an operating agreement. So I think that sometimes can be cost prohibitive, but I think it's also beneficial to talk to attorneys to get an idea of what they think what they're able to charge for that, and see if that works with the company, instead of perhaps thinking that there's no way I'm going to be able to afford that and adequately protect the company. So that's one component of it. And a lot of the points that Kamara raised were all great. And one thing that really flows through that in terms of talking about trying to be ready for when you have to produce those documents is good record keeping and document management, and starting those practices early on. Even if you're not hiring an attorney to do the initial formation or some of those documents, having sound record keeping practices will be beneficial throughout the company's life cycle. And that can be something that's not very expensive to develop those habits early on, having a central place where those type of documents are stored electronically, where hard copies are stored, and being able to retrieve them when necessary. So I think a lot of, Kamar raised a lot of points, but in terms of when you're getting to that due diligence phase, the way to have a relatively smooth phase is to have good record keeping practices that have been in place before you get to the point of now you're trying to raise capital from outside entities.
I think I would comment because I think David hit on a good point. What do you do? You need this legal advice and everything, but you're starting out, so it's not a whole lot of money. Now I was fortunate. I had immediately starting out with this thing I'm doing about 200 grand of dry powder. So I'm well funded to get this kind of stuff done. So I could do it right. But at the same time, again, if you're getting into private equity, man, someone told me, and probably Sean heard this, or probably even Dominique, anybody that's talked to me, and I've talked to, I would encourage you to speak with others that have already done this. Do not go into this without talking to people that's in the game already. And a guy told me, he said, Kamar, you've been playing ice hockey for all these years, and I understand why, because you're black just like I am, and we got to get in there and we got to box to get shit done, right? He said, but now in this game, he said it's finesse and it's figure skating. So now you got to get out of that mode of just get her done at all costs and deal with the consequences later. To sometimes you just gotta bite the bullet and talk to guys like Dominic. So here's three hacks that I would give and I don't know everything. Again, I'm talking to people all the time still, and I'm learning every day. Use AI to have a conversation with. AI is actually a good lawyer to talk to. They'll answer your questions, and then you can be more prepared to then talk with an attorney, and it'll probably save you some money because at least you have somewhat of a direction as to which way you want to go from a legal standpoint, and that could save you time because they charge by the hour probably. So do that. Talk to AI a lot. Get an idea, and then you can run it by an attorney, maybe save money. The second is to speak with others that may like you, request their time. Different on LinkedIn, there's a lot of people starting up funds or running funds. See if you can talk with them and just get feedback as to do's and don'ts, how to start out, all those entity, corporate structure. I used to think that was just complete bullshit. Just hey, it doesn't matter. Let's just set up something and let's roll. But it can have dire consequences if you do that wrong, and some of it can land your ass in jail. I'm telling you.
Right.
So
look, I don't mean to cut you off, but you talk about risk aversion, and that was one thing. Like I've set up like several entities before.
yeah, but
not
you
fun
setting it up
entities, but like
a professional setting it up is two different things.
well, that's what I'm saying. It's two different products, and so and that's when you mention risk aversion, I'm like, well, I'm not risk averse. It's just I like to manage risk where it's like a unknown. So like if it's a corporation or if it's a product or service or something like that, I'm fine with that. I've done that before. Those are different. But when it comes to something that is financial, then it's different because you get into the Investment Company Act and all these different hurdles.
Yeah, I used to be in the securities business years ago too. So, but this is, I'm telling you, it's different. It's legal risk. And I was a professor. I had a Series 7 and all that. I was capital markets real. So some of this stuff come full circle, but there's legal risk and laws change, and you may be perfectly thinking you're doing something right, and boom, and guys like Dominic can help you when you say, hey, I'm planning on, let me run this by you. I'm planning on raising money and I want to pay a finder's fee to people, which finder's fees are legal with in this space because you're not acting as an investment advisor. And it doesn't qualify under the SEC, it's under Regulation Q. It's a different type of thing. So you don't need a license to collect a finder's fee for helping somebody raise money at this kind of level. But it may be a line that somebody like Dominic will know, okay, if you go that far, yeah, it qualifies under that. But if you keep it within here, then you're okay. And those are the kind of things that even a risk adverse person may not be able to detect because they're not an attorney, they're not a lawyer. It's legal risk is a whole different ball game, and it's a reason why he's got a JD, and he's got a lot of experience. He looks like a kid, but
Yeah.
this guy's been around a little bit, and he's my frat. But so that's a tough thing. I think some things you got to bite the bullet. If you're going to play in this space, you're just going to have to get the money and get that set up right so you can run. Because if you don't, it can get you in trouble with lawsuits and it just and then I'm telling you, man, if you go in front of a company that can write a 7 or 8 figure check, let's say, and let's say they want to just help you out. Okay, here's 300,000, go away. But they might do a little due diligence and boom, this lawsuit pops up. And they're looking at that. I've engaged now. I've got a contract where I'm helping a larger PE firm do this kind of work, and they're meticulous as shit. I mean, just looking up all kinds of lawsuits on everybody. Oh, this guy's got a lawsuit. Red flag. And so you don't want to have that because it's going to hurt you raising money. And if you do have that, then you can mitigate that and say, hey, I had this, or, you can speak with these kind of guys to flush that out, before you go down that road and get exposed. It's a painful process. So yeah, I mean, it's not an easy question to that, David. I think again, private equity. This is the third thing. Someone told me they're running a several $100 million fund. They said if you're not making good money off of this, then don't even do it. Don't even do it. It's too much of a headache. So if you're not planning to make big money, don't even bother with it. If it's little money, then it's not worth it. That's exactly what they told me. They said it's too much of a headache to be making small change. You're trying to make big money. You're trying to make millions of dollars in this game, and if it's not, if it doesn't have the ability to do that, then probably should do something else. And so that would be, but I think everybody understands that in this group.
Yeah, that's a good point too. I mean, I don't know if you met Keita. Have you guys talked to Keita? You know who is?
Yeah, his last name's is it Blackwater?
I think
I
I think he was at the event
with
down in Florida.
Yeah.
He was down there. I didn't go to that one, but he was there, and he was also at the one in New York.
Yep,
I actually met him at the NEIC event in April, and that's how I met Jay and Jewel. But he said something similar to what you said, Kamar, which was the risk part. And we were talking about accredited investors, and trying to find a way to bring people along that aren't yet accredited. Like, well, you can always. He said that exact thing as soon as I said it.
It breaks that veil when you do that. And I know people are trying. The only one I let into my investment is my cousin. He's my first cousin. He's like a brother. And he's the only one. And I got another best friend from high school. I think he is accredited, but my cousin's the only one that I know is not accredited. And there's a friends and family loophole you can use. But he's right. He's the only one. And I said, man, this is how it's going down. And, and I'm only letting you put this much in. That's it. is far below
Yeah.
what the minimums are. So yeah, it
And
can
there's
get you
like
into
there's
trouble, and
some
those are
hybrid
the
legal.
ones that's going to get you in trouble. I hope my cousin. I don't think he would, but
Well, no, I mean there are like
yeah.
hybrid legal structures that you can do, and different regs that you could take advantage of. But you know, Keita was basically saying what you said. It was like, you know, this business, venture capital, PE, the goal is what you were talking about, and so like shooting for accredited investors and big million/billion-dollar deals in general. That's the space that we're playing in, and so, you know, it's just
Figure skating,
yeah.
not ice hockey. Ice hockey's at the, you know, and that's what he told me, and it clicked right away, just like with you guys. You could see it in your head. Ice hockey's aggressive and bumping people, and figure skating's nice and finesse, and beautiful and elegant, and that's where we're at now, fellas.
Sounds good. I think
Hey,
it's okay.
roll out.
I'm gonna hit you up, both of you
Yeah.
guys, Dominique, if you don't mind, Dom and
Definitely don't
Mark.
mind.
Yeah,
Thoroughly appreciate it,
badass.
both of you.
He's got a lot of knowledge, and he's at a firm that's got a lot of horsepower. So I had talked to you about something else, Dom, too, with my client, much bigger than me. I'm pocket change. This is you
Not about the size of, you know, the client's resources, you know, treat them all the same.
Yeah, huh? What's that?
I said, treat all the clients the same. Doesn't matter how much
Yeah,
money they
right. Bullshit. If you're
You'll
doing
see.
that, you're already doing something wrong.
Yeah.
Oh my goodness.
Yeah, we'll talk about that too. I'll send you a note. I'll just send you an email
Okay.
on that situation. It
Sounds
just popped
good.
up, and it's part of my to-dos for this week. So
Sounds good. Definitely want to thank everyone for taking time to be part of this conversation this evening. Definitely looking forward to the next one. Hope everybody has you know, good rest of their evening, great week, and look forward to connecting with everyone offline.
Yeah, thank you for the conversation, Dominique. Appreciate it.
Of course.
thanks, brother.
Yeah,
Have a
thank
good
you
night.
very much.
All right.
You're welcome.